Welcome to the Hurst Trading Room. This is our video update for the 20th of May 2013. We have had another very good week in the markets because all three trades that we are in out of our four instruments moved further into profit this week, and so that's been a really good thing. And we haven't had the opportunity to enter any new trades because our current trading opportunities are simply keeping going. So things have been a little bit more relaxed in the Hurst Trading Room. We're not having to make any new or complex decisions. We're simply watching our trades move comfortably further into profit. Let's take a look at the trades that we have open. We'll start with them as always, and then we'll move on and speak about the opportunities that lie ahead of us in the week ahead. Before we take a look at the markets, please make sure that you have read and understood these disclaimers. First of all, our long trade in the NASDAQ has turned out to be an extremely successful trade. As you can see here, this green line is our entry level, our entry price, and our T1 target, the level at which our first trade exited, was way down here. That was our T1 target. Our T2 target was over here at about the 2900 level, and at that point, of course, our trading opportunity had provided a locked off profit because our stop loss for our trade 3, remember we take 3 trades of course for every trading opportunity, and this is specifically done to manage our risk and to protect ourselves in case the trade only partially fulfills its objective or its target, and allows us to run with the profits in the event that the trade far exceeds our expectations, which is exactly what has happened with this trade in the NASDAQ, because our trade 3, as you can see, is currently right up here at this level over there, and our exit from our trade 3 is at this level here. There is the long exit, and that is of course our 3-bar trailing stop, which we apply as soon as our trade 2 has exited. We apply a 3-bar trailing stop onto our trade 3, and so even if the market does now turn down, we will have locked in a much greater profit in our trade 3 than we took in either trade 2 or trade 1. And this is a really good example of why we take this 3-trade approach. Sometimes the market will move in the direction that we expect, and it will not only achieve its cyclic targets, but it will far exceed all of our expectations. And that's why we have a trade 3, and that's why the nickname for the trade 3 is the lottery trade, because occasionally you strike it lucky with your trade 3, and you can watch your profits simply growing with your trade 3. So that's exactly what's happening with the NASDAQ at the moment, and it's a perfect example of why we take the 3-trade approach, because occasionally the markets will just really keep going in the direction that we're trading, and we want to take advantage of that. We wouldn't have wanted to have exited all of our trades down here at the trade 2 level, which was the cycle target or the cyclic target. We wouldn't have wanted to exit all of our trades there because we'd be sitting there feeling left out as the market continued to head upwards. You might know, if you read my blog, which I publish on a Saturday, available through the sentienttrader.com website in the blog menu, you might know that I suspect that what Hurst called a pseudo-trend might be developing. And so that's something that we will discuss when we look at the trading opportunities in the week ahead. Now, as you will know, at the time of entry into this NASDAQ trade, and the entry was way back here, just almost a month ago in the tail end of April, at that time there was some analysis uncertainty And so for that reason I entered into a long trade in the NASDAQ, but I didn't enter into a long trade in the S&P 500 because of that analysis uncertainty. There are times, or perhaps I should say, analysis uncertainty is a reality. Obviously, in an ideal world, we would never have any uncertainty about the analysis that we're performing, but it is a reality. We have to constantly deal with the fact that sometimes we're uncertain about the analysis that we've performed. And the way that I deal with it, that you probably know by now, is that I trade closely correlated instruments. And I find the instrument that seems to offer the clearest analysis, and I will make a trade in that instrument, which is what happened in the NASDAQ, whereas I won't take a trade in the instrument that the analysis seems less clear in, which in this case was the S&P 500. It has meant that we have been able to take advantage of a very profitable trading opportunity in the US stock markets by trading in the NASDAQ, but of course we missed the opportunity in the S&P 500. So that's why we don't have an open trade in the S&P 500. Let's take a look at our open trade in the euro to US dollar. Here is our short trade in the euro to US dollar, and it is a short D category trade, which is the short trading opportunity that presents itself when the market heads down towards the 40-day cycle trough. And here is the nest of lows indicating that a 40-day cycle trough is due now. Very possibly it formed last week on Friday, although it's too early to say that with any certainty. The market might still fall a little bit lower. We were, of course, expecting the trough, this 40-day cycle trough, to occur above the 40-week cycle trough at the beginning of April. We were expecting it to occur above that trough, but as you know, in Hurst's cyclic theory, there's no absolute rule about that. In Elliott wave theory, if you know anything about Elliott wave theory, you know that a wave 2 cannot drop down below the start of a wave 1, and so there is an absolute rule. So if price was to have dropped down there, then that would have affected your Elliott wave count, possibly, depending what your Elliott wave count was. But in Hurst's cyclic theory, there is no such absolute rule. It is perfectly possible that a 40-week cycle trough did form at the beginning of April, as our analysis shows, and that the first 40-day cycle trough actually drops down below that level. That wouldn't negate our analysis. It wouldn't render it invalid. So we weren't watching that level with great anxiety in case it rendered our analysis invalid. It wouldn't have rendered it invalid, but we did expect the trough to occur above that level. And one of the reasons for that has to do, of course, with the cycle shape. It has a higher peak, as you can see over there, and we expect a bullish shaped cycle following the 40-week cycle trough. So that's a little bit of background to the trade. But what's actually happening with the trade, of course, is that it is a D category short trade, and we entered it after the market crossed down below the FLD. This was the level of our entry. That was our entry price, and our T1 target was over here. So we exited our trade only a day after we entered the trade, and our T2 target was only a little bit lower, somewhere over there. And the reason why T2 and T1 were so close together has to do with the fact that our entry was slightly displaced from the FLD. As you can see, the actual level of price crossing the FLD was slightly above our entry level. And that has to do with some of the subtleties of entering trades on the basis of price crossing the FLD, which you will know is covered in detail in Module 2 of the FLD Trading Strategy course. There are several subtleties about entering into trades on the basis of price interacting with the FLD. And so we had a slightly delayed entry into this particular trade. Nevertheless, we are still in our trade 3, and our trade 3 is at the moment making more money than our trade 2, but as a matter of interest, our exit from our trade 3, although it is locking in a profit, our exit is up there. Let me just clear this chart. there's the exit from our trade 3. So if price was to suddenly bounce out of this 40-day cycle trough with a great deal of power, then potentially we will of course make a profit out of our trade 3, but we might not make more money than we made from our trade 2. That's the way the system works. Sometimes trade 3 strikes it lucky and makes a lot of extra money. Sometimes it makes about as much money as trade 2, and sometimes it makes less money. But that's the way it works. Now, why is our stop right up there? Because of course we've applied our 3-bar trailing stop, and we had an inside bar last week on Thursday. Oh, that arrow went a bit skew. There we go. On Thursday, this was an inside bar. As you can see, high lower than the previous high, low higher than the previous low. That's an inside bar on Thursday. Therefore, our 3-bar trailing stop is right up here at the high of Tuesday's price action. So that's where our trailing stop is for this trade. So that's what's happening in the euro to US dollar. Things are looking good. At the beginning of last week, it looked as if though this trade, this D category trade, might turn into a break-even or small profit trade. We had in fact taken our profit from trade 1 and trade 2, so we'd already locked in some profit. But fortunately, it has surprised us in a good way, and we've made more profit out of this trade that we might have originally expected. D category trading opportunities are often trading opportunities that you need to be quite nimble getting out of, because very often the market will not come down as deeply as it has in this instance into the 40-day cycle trough. So that's the euro to US dollar, good profitable trading opportunity. Let's take a look at the British pound to US dollar. The British pound to US dollar has also carried us into further profit this week, so it's been a really good trade for us. It is slightly different to our trade in the euro to US dollar because it is an F category trade. An F category trade is of course a trade that one enters, or a trading opportunity that one enters into as price crosses down below the FLD, as price moves down towards the 80-day cycle trough. And there you can see the 80-day cycle trough is expected fairly soon. I'd be a little careful of jumping to the conclusion that the 80-day cycle trough has formed, except for the fact that of course over here we have a big trough of at least 18-month magnitude. And every week I say this, soon I must stop saying it. It is at least 18-month. It might be 54-month magnitude. As you can see, there's a 54-month diamond over there. But I consider it to be of at least 18-month magnitude. And following such a major trough, we of course expect the troughs of the shorter cycles to come in early. So as you can see over here, there have been 69 days since that 18-month cycle trough. And 68 days is in fact the average length of an 80-day cycle. So if an 80-day cycle trough forms now, I wouldn't be surprised. I would expect it to come in slightly early, or at least on time. You must remember the principle of variation, which tells us that the wavelength and the amplitude, of course, of cycles varies constantly. So I'm not going to start getting anxious about the fact that this trough should have occurred. If it doesn't occur, even if the market keeps moving down for another 2 or 3 weeks, that's perfectly possible. But in terms of monitoring our F category short trade, we are now in our trade 3 only, and so we are applying our 3-bar trailing stop. Let me just zoom in slightly, and we can have a look in detail at that trade. The British pound US dollar, as you can see from all those green trade lines, has been really good for us recently. It's been moving with very clear cycles. You can see all the green trade lines here and here. We've had a very good run over the past 2.5 months, I think, with the British pound to US dollar. And this F category short trade has been no different. So where was our entry level? Here was our entry level, our entry price. And that might surprise you because, of course, the FLD is higher than that. And the reason for that was because as price headed down towards that FLD, I again had some analysis uncertainty. And if you go back and look at that video from 2 weeks ago, you will know that there was a possibility in my mind that this might have been a B category interaction. It was just a possibility. It was a less likely possibility in my mind, but it was a possibility. And so because of that, I delayed my entry into this trade. I waited for price to come down to the FLD, and I watched to see how price reacted. And interestingly, the market played a little bit of a game with me, because it came down to the FLD, as you can see, and then it tracked along the FLD. It started looking very much like a B category interaction. I set my entry level for the potential F category trade at the low of the bar before. So there we go. So on the Thursday of that week, we were stopped into our F category short trade. And as a result, our T1 and our T2 targets were very close together. T1 was there, T2 was there. So they were very close to each other. And that's what happens when you displace your entry price from the level of the FLD, which, as you know, is something that we do often need to do in order to protect ourselves from incorrectly identifying the FLD and price interaction, which we are actually trading. And because I had the uncertainty of whether this would turn out to be an F category or B category interaction, I displaced my entry price, and as a result, our T1 and T2 targets were very close together. And what it actually meant, of course, was that we made slightly less money out of the trade, but we nevertheless made our full risk that we were taking. We made that in profit when we exited from our trade 2, and we made a little bit less than that when we exited from our trade 1. So things nevertheless turned out to be profitable, and of course we were in a trade 3. At least we only had our trade 3 open, and we started applying the 3-bar trailing stop. And so here is where that 3-bar trailing stop is currently. We didn't have inside bars last week as we did in the euro to US dollar. And so you can see the highest high of the previous 3 bars is over there, and that's our 3-bar trailing stop. And so that is where we would exit from this short category F trade. So we are going to make more money out of our trade 3 than we made in our trade 2. So it's another good example of why we take the 3-trade money management approach that we do. We split our risk between 3 trades, and it's a very good example of why we do that, because at the time of entering into a trade, we have an idea of where the market is going to go, but we don't know the exact path that it's going to take, and that's why we take the approach that we do. Thank you for joining me for this summary of the current trading activity in the Hurst Trading Room. In the full video, I take a look at the analysis in each of the instruments and identify upcoming trading opportunities in those instruments. If you are interested in viewing the full video, then please go to our Sentient Trader website, take a look at the training courses Hurst Trading Room page, where you can learn all about subscribing to the Hurst Trading Room. Thank you for your time and for your interest in Hurst cycles.